Hello, welcome back to this week's market update. Today is Monday, October 20th, 2025, and we'll jump right in. Following some recent volatility tied to renewed US-China trade tensions, markets steadied and ended the week higher last week as the diplomatic tone improved and early Q3 earnings helped restore investor confidence. As of Friday, October 17th, the Nasdaq Composite led major indexes up 2.1%, followed by the S&P 500 up 1.7%, and the Dow Jones Industrial Average up more than 1.5% last week. Now, reviewing some economic data from last week, it was a pretty light week on economic data as the ongoing federal shutdown has delayed a lot of data releases, including the CPI, the PPI, retail sales, and many other data points. But despite that, we did have some pretty important market news last week from more private sector data points. We had quarterly earnings. We also have a Federal Reserve rate cut meeting next week. So looking at some rate cut odds for next week's meeting, it looks like the market is pretty much set on expecting a 25 basis point rate cut at the October 29th meeting here, the current range being at 4 to 4.25%. Investors expecting that to fall a quarter of a percentage point. Then when we look ahead to December, markets are still expecting about a 94% chance of a second rate cut at the final meeting of the year. So just looking briefly at the expectations for cuts in the road ahead. Shifting into some early earnings data, we did have several big banks report their Q3 earnings last week with some mixed performance despite most banks posting better than expected earnings growth. So we had JP Morgan, Bank of America, Wells Fargo, Goldman Sachs. They all reported better than expected earnings, with Wells Fargo as well as Bank of America ending up about 5% last week. On the other hand, JP Morgan and Goldman Sachs fell for the week. So JP Morgan slipped after announcing a $170 million loan charge-off tied to the bankruptcy of subprime auto lender Tricolor. On the other hand, Goldman Sachs declined as weaker trading results and higher operating costs weighed on the sentiment for the stock. Now, despite the different share price reactions in the big banks, overall earnings were pretty solid among those largest banks. However, that may not be the case for regional banks, which will start reporting in the next week or two. Looking at some charts here, we did have some credit scares and bankruptcies last week for some pretty large customers among regional banks. We talked about that one credit loss for JP Morgan. That seems to be hitting regional banks a bit harder as those big banks have a greater ability to absorb one-off losses like that. On the other hand, regional banks can take some pretty big hits from credit losses. So right here, looking at the repo chart, the repo program, the repurchase program is a overnight liquidity funding program for banks to borrow from the Federal Reserve. Banks will exchange highly liquid securities like treasuries, MBS, for cash to cover short-term funding needs. So this has been a program rarely used in the last 3-4 years. You can see typically that is within a few million here. This is in billions. We had one pretty high day in July, over 10 billion, but we've had two really high days, over 5 billion of borrowing in the last week. So that's something we want to keep a note on, as banks typically only tap into this when they are seeing some liquidity and funding needs. In this chart here, you can see how regional banks did take a pretty big hit over the last week and then recovering a bit on Friday to close off the week as Fifth Third Bank Corp reported stronger than expected earnings and some pretty contained credit losses. Looking more broadly at expectations for the quarter, you can see for the S&P 500 currently expecting about 8.5% year-over-year earnings growth. That's quite strong there, and this is led by information technology and financials. Last week we had Taiwan Semi report their quarterly earnings with both revenue and earnings growing more than 30% from a year ago. So you can see that's increased slightly over the last few weeks to be a bit more bullish at a 21% annual expected earnings growth. Financials, obviously, we looked at some pretty strong bank earnings. Definitely some risks in the regional banking space, but overall, the market is pretty bullish on financials earnings this quarter. Utilities earnings expected to grow pretty strongly, materials and industrials. So, all of these being pretty risk on sectors is a good sign for the overall economy that companies seem to be faring pretty well. Last but not least, the VIX, which is a measure of the implied volatility in S&P 500 options in near term. This spiked to above 24 last week, which is a pretty high level, actually the highest it's been in 5 months, on some renewed trade tensions between the US and China, as well as some regional banking concerns. So that seemed to settle into the end of the week. We'll see how this trend continues into the rest of October. But just a sign we want to keep, we are seeing some rising implied volatility, meaning that traders are getting a little bit uneasy about the market in the coming weeks, according to options markets. That concludes this week's market update. We really appreciate you tuning in, and we look forward to seeing you again very soon. The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.